Good afternoon, ladies and gentlemen. Well, we're very pleased to be back at the second investment week. We were here last year, and wonderful to see so many of you. And you're taking time out on a Saturday morning and in the afternoon to gain some knowledge about investing. Over the next 20 minutes or so, I'm going to just introduce very briefly CapitaLand to you. I'm quite sure all of you must have at least shopped in one of our malls or otherwise stayed in some of our service residences, either in Singapore or overseas, or perhaps even done some work in one of our tenants in our office building. So sit back and relax. A copy of this presentation actually has been uploaded onto our website yesterday. It's on www.capitaland.com. And if you want to learn more, you can also go and move into our website. So let me just start. I will just give you a brief summary of our last financial results, December ended 2012. In fact, in 2 weeks' time, we'll be announcing our first quarter results on the 26th of April. That was announced yesterday as well. I'm going to describe and update some of our business units to you. We had a reorganization, a simplification of our organization process, and we now have 4 core business units from 6 previously. And then really wrapping up by highlighting to you our focus for this year, 2013, and we conclude with that. So let me just, a brief scan of the results. As you can see, revenue was 3.3 billion for the full year, which is up 9%. Profit after tax and minority was 930 million. That's down 12%, and that's really, our profit comprises of 3 elements. We have what we call the operating profit, which is actually 369 million. It was actually up 5% year on year. And then we have what we call revaluation gains. We have investment properties, and under the accounting rules in Singapore, we revalue our investment property twice a year, and any gain or debit is actually taken off straight from the profit and loss account. And then the third element within the profit element is actually what we call the portfolio gains. That is, if we sell off a building or sell off an asset and we realize the gain, that is booked into it as well. So on the development side, you can see the operating profit. It was because of higher operations from both our development business in Singapore, China, as well as Australia. The shopping mall business also contributed very strongly. At the same time, we had increased fee-based income from the REITs and the private equity funds that we manage. And the balance sheet for CapitaLand, as it stands, is still very robust. The technical term is net debt over equity. It's a measure of the amount of borrowings that we have. Let's say for every $1 of shareholder funds, we borrow 45 cents from various, either the banks or financial institutions, capital markets. So far, last year, we invested 4.1 billion into new commitments of new investments. So some of these are pretty long-term, between 3 to 4 years gestation. And, you should see us reaping the rewards of this when they complete. And we've also, for the 2012, proposed a higher ordinary dividend of 7 cents versus 6 cents last year. This is just the PATMI numbers. EBIT, obviously, is earnings before interest and tax. That was also over 2 billion. And skip to the next one. So this is just an aggregation of the total amount of real estate that the CapitaLand Group manages. In total, it's about 63 billion, of which 25 billion of those worth of properties, assets, are actually either on our own balance sheet or in the form of joint venture. About 12 billion of those are held through our private equity funds. And our REITs control about 21 billion. And we have about 5 billion worth of properties that we actually manage on a management contract. That means we are not the owner, but we are actually the manager of those properties. These are the 4 key business units, as I said. We have CapitaLand Singapore, which includes all our residential projects and our office projects in Singapore. We have also included Malaysia now as an extension of Singapore. And then, obviously, within Singapore, we have the two REITs that owns assets here, which is namely Capital Commercial Trust and Quill Capital Trust, which is actually listed in Bursa, Malaysia. And then we have CapitaLand China, which comprises all the residential units and office business in China. In particularly, I think the Raffles City portfolio is very large. We actually have 8 Raffles cities in China, of which 4 of them are operational. The rest are still under development. And we have some fund management business as well. And then we have CMA, or in full it's Capital Malls Asia. I'm quite sure some of you are very familiar. It's separately listed. We own 65%. It's a subsidiary ours. And currently they have a portfolio of 102 malls, which puts them as one of the largest owner, operator, and developer of shopping malls in Asia. And within the Capital Malls Asia, they are a sponsor. They actually own stakes in Capital Mall Trust, which owns 15 malls in Singapore. Capital Retail China Trust, which owns 9 malls in China. And Capital Mall Malaysian Trust, which owns 5 malls in Malaysia. And the last business unit is the Ascott Group, which is actually the largest international service residence owner-operator. They currently have a total portfolio of about 31,000 service apartments throughout Pan-Asia and Europe. The focus really for CapitaLand over the next few years is very much on China and Singapore. In terms of asset, together these two markets comprise 72% of our total assets base. And in terms of the earnings contribution as well, you can see these two principal markets account for 77%. So how we perform in Singapore and China will actually move the needle for CapitaLand. If I give you the split by the business unit, which I just mentioned earlier, you can see this is a contribution. You can see that Singapore contributed about 17% of the asset base. China is 21%. The retail business under CMA is 31%. Ascott is 10%. If you look at the earnings contribution split, you can see that the big contributors are obviously the shopping mall business, which accounts for 34%. And then we have Singapore, which contributed 25%, and China 16%. These are the big elements. I mentioned about committing 4.1 billion of new investment in 2012. This is just a full listing of those undertaken by the entire group. Let me just briefly mention some highlights within each of those business units, starting with CapitaLand Singapore. On the residential side, you can see that we achieved sales of over 1.3 billion last year, which is slightly down from 2011. But take this against the backdrop where the Singapore government actually implemented 6 cooling measures to try and cool down the property market, for which I think most of you are familiar. So obviously the volume was affected. We actually sold lesser units, only 681 units last year versus 844 the year before. But in terms of the average sale value per unit, actually we recorded a higher amount of 1.9 billion because most of the projects that we sold are actually higher price projects at the upper end of the segment. But the good news is despite the cooling measures, we actually saw a pickup in our sales momentum year to date up to March, end of March. That's because I think we actually offered some incentive scheme on 2 of our big projects, the Leiden, which is in Farrer Road, and also the Interlace, which is expected to complete by the end of this year. In fact, that's quite a spectacular development. If you're driving, from along the AYE towards the city, you can actually see it, standing out very prominently. It's almost like a fort. Yeah. And we still have units available if you're still interested. In terms of the construction progress, last year we handed over the Wharf Residence. This is along Muhammad Sultan Road. And the rest of the projects works, I think, in progress and on schedule. This year we hope to hand over Urban Suite, Urban Resorts. These 2 developments are more of the high-end products. They are located next to each other along Cairnhill Road. And of course, as I mentioned, Interlace will be handed over later at the end of the year. This was the last round of cooling measures implemented by the government. So obviously it's dampened demand, but having said that, you saw that recent launches, actually the take-up has still been very healthy, particularly I think even in the suburban mass market. We do think that trading volume is going to be impacted, and more so I think on the high end, particularly because of what this ABSD, Additional Buyer Stamp Duty, which has been imposed and increased on the foreign buyer. So you've seen the foreign buying content among the primary market sale fall from about 21% at the peak of the market last year to currently about 5-6%. So I think this will take some time before the foreigners come back. They will just adopt a bit of a wait-and-see attitude. So the outlook is that we have, as I mentioned, implemented some incentive scheme to try and boost sales. We have a pipeline of about 2,800 units left in the residential business. Most of this in what we feel is pretty well sought-after location. And these are just some of the new imminent launches of the projects. For those who are interested, I think Marine Point is a development that we did an en bloc transaction. We hope to launch it sometime later part of this year. That's directly opposite Parkway Parade, so it's a very good spot. And together, there's going to be a new MRT going into that part of Singapore as well. Bishan Street 14 is actually a site that we successfully bid. It's right next to our Sky Habitat, but this probably will be priced slightly lower and with smaller units versus the Sky Habitat, which is what we call like a bungalow in the sky, very large units. And we will continue to try and replenish some of our land bank. If you read, yesterday we were unsuccessful. We bid in one of the sites as well, very aggressive. The winning bid was the UOL Group. There was a residential site in Sengkang West. I think the winning price is about $460 per square foot per plot ratio. So it's still very aggressive and keen competition from developers. Our office portfolio is really held through our REIT, Capital Commercial Trust, and I think CCT is still enjoying a boom at the moment. It's benefiting from what we call positive rental reversion. This is the average rental of its entire office portfolio, and it's still on the uptick, trending up. In terms of the office portfolio development, we have two projects, two Grade A buildings, under development. One is a redevelopment of the former multi-story car park. It's been named Capital Green. If you drive past that area, you can see work is going on, at the moment. We hope to complete that by the fourth quarter of next year. At the same time, we also have another development called Westgate. This is actually on a built site that we were successful in bidding. It's at Jurong East, right next to the MRT station, and it's actually connected to soon to be open the Ng Teng Fong General Hospital, as well as our Capital Mall Trust J-Cube. It'll be completed, the office building, by the end of 2014. But the good news is the shopping mall, there's a shopping mall there as well, will open before Christmas this year, so look out for that. CapitaLand, in fact, the entire group is moving into this building from end of 2014. We will occupy about 52% of the entire office space. Earlier, I think this morning, someone came to ask me about this project, and I think there's a write-up about Iskandar. We introduced it in the investment book as well, so read about it. We were successful. We actually have a 51% stake in this joint venture together with a Malaysian partner, Iskandar Waterfront Development. It's actually Danggar Bay, and it's a reclaimed island. And we hope to launch this project, the phase one of this residential project, probably towards the end of this year. I mentioned earlier about the last bid by UL at about $460 per square foot. Current prices in this area is Iskandar is between 800 to 1,000 ringgit per square foot of freehold land, completely all built up. So that's about $450. So is that attractive? Yeah, and you'll be living on an island, waterfront. 75% of this will comprise of residential units in this project. But there will be a shopping mall, there will be a marina, there will be lots of F&B, lots of al fresco dining, and some office space as well. It's actually very close. For those of you who have not been, Danggar Bay is only about 15 minutes drive on the coastal highway from Johor Bahru. So you can access it also from the Tuas Second Causeway, but at slightly longer distance. Next, just a few slides on CapitaLand China. On the residential side, I think we saw the continued momentum in the pickup in property sales from the first quarter last year, despite the cooling measures implemented by the Chinese authorities as well. So you saw for the full year of whole of 2012, we closed about 3,000 units in China, worth about 7 billion. And year to date, I think the momentum is still pretty strong. These are some of the pictures of some of the recent projects that we launched last year and the prices that were achieved. This is a recent launch, I think, in the first quarter this year. It's actually apartments that is part of the Raffles City in Shenzhen, which is under construction. We put out about 800 units and we clinched about 74% sales turnover just in the fourth quarter this year. I'd like to introduce to you the Raffles City portfolio. As I mentioned, CapitaLand China actually has 8 Raffles City in China. The first 2 obviously has been completed and trading very well. Raffles City Shanghai and Raffles City Beijing. You can see they enjoy occupancy in excess of 90% and have appreciated in valuation at least 10% in the last year. The bottom 2 projects, Raffles City Chengdu and Raffles City Ningbo, were only opened in September. This is a retail shopping mall. The office building is still being filled up with tenants, and they're both looking quite well. These are the rest of the Raffles City, as you can see. I'll show you a picture of the current construction progress as well. On the top, you have Raffles City Hangzhou, which is expected to open in 2015. And then we have our second Raffles City in Shanghai, in Changling. This is a very prime site, which will also open in early 2016. And then we have Raffles City Shenzhen, which I mentioned, again, target to open in 2016. And finally, I think the biggest Raffles City so far we have clinched in China, Raffles City Chongqing. This is master architect by Moshi Safi, who did MBS. So you see there's some resemblance, but this is even 3 times the size of Marina Bay Sands. It consists of 8 residential office towers. And while MBS has a sky bridge, this one here is actually a sky podium. That's where will be the reception of the 2 international 5-star hotels. So it's spectacular. And it's a beautiful site. It's at Chao Tianmen, which is actually a historical site where Admiral Cheng Ho many years ago came and sailed through the Yangtze and hit this place. These are some of the residential units. I think we hope to have about 4,000 units launch ready. That means with sales permit ready to launch pending market conditions. Some of the projects in Beijing, in Ningbo, as well as in Wuhan. The lakeside is actually what we call a mass market product. And Wuhan is a very thriving city at the moment. This is probably one of the cities where we hear that CapitaLand is going to invest a lot more money. And we hope to hand over 3,000 units in this year. This is important because in China, we can only recognize profit on handover. So this will be quite significant. Capital Malls Asia, perhaps don't require too much introduction. As I said, they have 102 malls. But in terms of the performance in China, you can see it was very strong. There are 2 main parameters that you have to monitor when you are analyzing shopping malls. One is the shopper traffic. And you see in China, shopper traffic was up 7% year on year. And the other one is the tenant sales. We have point of sale in all our tenants across all our malls. So we monitor them. And that was up 9.8%. But if you take out the what so-called Tier 1 cities, which is your Beijing, Shanghai, and Guangzhou, you find that actually the rest of the portfolio, the tenant sale was up 13%. Very strong figure. On what we call same mall basis, that's to compare the net property income. China was still up almost 17%. Again, very strong. Singapore, obviously, a very mature market, so 2 to 3% is sort of growth that we see every year. But Malaysia is doing very well. It's tracking, in fact, exceeding their GDP growth of about 5-6%. It's growing at about 7-8%. We opened 9 new malls last year, and we completed 2 what we call asset enhancement, which is namely Bugis Plus. I think some of you may have visited it. It's quite a transformation compared where it was probably before that, you know. And of course, we also completed the amalgamation of the atrium with Plaza Singapura. It's now called, Plaza Singapura. You walk through it, you won't. It's almost seamless, and I think it's a very interesting place, ready to shop and to eat. Lots of new F&B tenants. We brought them, some of them in. In China, there were, the other malls that were open. So I think in terms of new development, we are targeting to open 2 of these. One is obviously the Bedok Mall, which we actually co-situated with our Bedok Residences, which sold very well last year. Of course, Westgate. This is the retail portion, as I said, which will open, by Christmas this year. These are some of the tenants that we've signed up: Isetan, Din Tai Fung, Food Republic, just to mention a few. And in China, we'll be opening 3 malls. Capital Mall Tianfu, which is a very big development in Chengdu, Meilicheng, another mall in Chengdu, and the last one is actually an extension also in Chengdu. This is the Qingniu Mall Phase 2. In India, we're going to open 1 more mall in Bangalore. Ascott Limited is our service residence arm, as you can see. Operating profit was up about 5% to 130 million. Added 14 properties with about 2,800 units. And we also entered 2 new cities last year, Xiamen and Mumbai. In terms of committed investment, they invested about 850 million. At the same time, they divested properties to the value of about 330 million. And at the same time, invested about 20 million to refurbish some of the older properties, particularly the one in London and in Paris. This is what we call in the trade, the key monitor of how service residents are doing. RevPAR stands for Revenue Per Available Unit. So you can see it was up quite strongly, particularly I think in China, notably up 15% year on year. Singapore was up marginally up 1%. So I think last year, the Ascott Group secured about just under 2,800 new units of management, of units under management. At the same time, there'll be planned opening of about 1,600 units this year. This is our financial products and regional investment, which we now has put under the corporate headquarters. Before that, they were under a separate business unit. And this is just a summary of the total number of funds that we manage. In total, about 37 billion Singapore dollars, and that comprised of about 18 private equity funds, 6 REITs, and in total, as I said, they generated a profit to us, to the group, of about $76 million. So, what are we going to look at for this year? I think for 2013, the focus is very much on, the new corporate structure. We announced a realignment and a flattening of our corporate structure on the 3rd of January. So right now, we are actually in the midst of our reorganization. We have done internal reviews, and at the same time, we are trying to simplify and some of the business processes, which hopefully I think will yield us some cost efficiency and some cost savings. At the same time, I think we're reviewing some of our smaller regional investment with a view to optimize and maximize value to our shareholders. So I think the desired outcome of all this is that we hope it will give us better visibility, a better clarity, and on the profitability of our core business, and ultimately, I think, deliver a higher long-term return on asset to our shareholders. So I think the ultimate goal is actually to improve long-term return on equity. We want to simplify our organization, focus very much on our 2 core markets, Singapore and China. It's what we call, by putting everyone together, we want to hunt as a pack, as one CapitaLand local team. In China, we're going to focus more on the key cities to build scale as well as to deepen our presence. So you find that in Shanghai, in Beijing, and in Guangzhou, we'll have not only our residential business, but we want to be a leader in Raffles City, the mixed development, in our retail malls, so that I think when we deal with the local government, we actually have a lot more clout. And focus on execution, that's very important. I think if you ensure that each of your projects that you undertake meet your return parameters and, let's say, deliver an IRR, a return of 10 to 12%, there's no reason why, when you add up all the projects, then at the group level, you should actually achieve that sort of return, less some of your corporate costs at the corporate level. And I think the other thing that CapitaLand is known for is that we believe in partnership. So we're looking to tap additional capital with capital partners to deepen the pool and broaden our pool of capital partners and diversify our sources of capital. So I think this is how the flow chart looks like. From our 4 key businesses, each of them, we're going to concentrate and drive the operational performance of each of these. The CEO that's appointed at helming each of this business, they're given very clear performance metrics. So I think they will be help to the task. And hopefully this will translate into positive and strong ROE at the business unit level and ultimately lead back to the group and deliver a high return to our shareholders. So in summary, I think our outlook for our business is very positive. We think our simplified organization structure will help us to scale up our core businesses. We are going to focus on execution excellence, which will allow the group to capture more value in our projects. We're going to maintain a very disciplined capital management, which will make our balance sheet more robust and allow us to grow even in very volatile periods. We will continue to be mindful of very efficient cost management so as to optimize our resources available. And in summary, I think the CapitaLand Group is well positioned for 2013 and beyond. Thank you very much.